Hey everyone, and welcome back to another video for today. So we are now in the second half of 2025. Can you believe it? We are now in Q3, so Q2 is over, which means that 2.5 weeks from now, we will have our new earnings season with companies like ASML, TSM, and Netflix reporting first. Now, in today's video, as always, we're going to have a look at 4 interesting companies that could be on your buy list, maybe should be on your watch list for the month of July. And as always, not here to waste your time. These are the 4 companies that we're going to touch on in this video. I hope you keep watching, and if not, at least leave me a like and a comment, and definitely subscribe because you are very close to reaching 100,000 subscribers. And of course, if you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, before we start this video, this is basically the state of the market at the time of making this video. We can also look at the last 3 months, right? So basically for the whole of Q2, it has been a very, very good quarter in Q2, right? Most of the stocks, especially those that we talk about, have been green over the past 3 months. So in Q2, Apple still down. Well, Apple down 5.65%. A lot of companies in the health sector, I'd say, energy especially, are deep in the red, but technology-wise, we are doing very, very well, which is why I took, my time to pick out these specific companies in this video, because I do think that despite the fact that these companies, yes, have gone up a little bit over the past couple of months, and especially year to date, they have not gone up that much that makes them not attractive at these prices of today. And yes, I know very well, I could have added way more. I could have still added, again, Salesforce, for example, could have added Adobe, could have added plenty of European names as well. Maybe that might be a second edition of these types of videos, right? Purely talking about European companies. If you're interested in that, do let me know down in the comment section below. All right, moving on to company number 1, and that's UnitedHealth. Also, special thanks to Fiscal.ai for sponsoring this video. Fiscal.ai, previously FinChat, is a stock research platform, the one that you're probably seeing every single day on this channel and during the live streams as well. I know a lot of you have tried the platform, and some of you actually became a subscriber of the platform, so I really, really appreciate all of that support, and hopefully it does make your investment journey much more enjoyable. Now, for those that are new, this is a stock research platform. You can see all of the available data to you, right? Right here, all of the metrics, margins, and all of that. We can even look at the transcript, all of the transcript. And if you don't want to read all of the transcript, for example, with UnitedHealth here, since they had their annual general meeting, we can just click on AI summary and it gives us all of the key takeaways. So for example here, the new CEO, the new old CEO return is not framed as an interim measure, but as a 3-year commitment to restore UnitedHealth Group performance. This signals a significant shift in leadership and strategy. They also talked about the company explicitly acknowledges errors in pricing disciplines and underestimation of care activity and cost trends. The significant retooling of forecasting efforts is a critical response. So you get here a lot of information. Even if we go back to the last earnings report, for example, you didn't want to go all over it, but here you get all of the key financial highlights. And of course, it's not just that. You can really go into the segments and KPIs of each and every company. For example, here we have total revenue, what has happened and what's expected to happen in the next coming fiscal years. And as you can see, this is still a company that generates over $400 billion in revenue and is expected to generate over $500 billion in revenue in fiscal 2027. Yes, I have a very, very small position now with UnitedHealth because I do think that there is just a huge disconnect. Yes, the stock should go down, should have gone down. But should it have gone down 50%? I don't think so. As you can see, it's still a company that is very, very profitable and still expect to become more profitable in the future. We've had a lot of insider buying. We had some selling as well, but insiders usually buy for only one reason. We also had politicians buy a ton of stocks in UnitedHealth. And yeah, when you combine all of that together, I guess you might have found a winner here. So all of that, of course, available to you on Fiscal.ai. Link is down in the description. And in the pinned comment, you'll get 15% off. New users will get Fiscal Pro for free for 2 weeks. So thank you very much for checking that out. For those that don't know, UnitedHealth business can basically be split up into two we have the UnitedHealth revenue, and we have Optum. Now here, as you can see, the big split, right? The majority does come from UnitedHealth, the other from Optum. But if you look at operating income here, the split is a bit more balanced, right? A bit more balanced. I wouldn't say 50-50, 60-40, or maybe 65-35, I'd say is the split at the moment. And last thing here, total UnitedHealth medical individual served over the last couple of years. It seems like it has peaked back here in the March quarter of 2023. Then we saw it come down a little bit, but we are seeing a very, very small rebound, right? It bottomed in the June quarter of 2024, and then it has, well, basically been flat-ish for 2 quarters, and last quarter it did go up a tiny bit. Now, the catalyst for me with UnitedHealth is very simple. At the end of July 29th, we're going to have the earnings report. And in that earnings report and earnings call, I do expect to get a lot more information, especially on guidance. And I do think that the market will realize that, the situation maybe is not as bad as previously feared. There might still be some uncertainty, but way less. And so the stock will probably make its way back up. $350, $400 this year is definitely a possibility, right? So I think that's the big catalyst, is just the upcoming earnings report and earnings call, just to get way more information from management. So yeah, I had to put this one still on the list. Moving on to company number 2, and yes, I'm sorry to say, but it still has to be PayPal. PayPal in the 70s, even in the 80s. I mean, we started the year in the 90s, right? That's why right now the stock is down 13% year to date. Over the past 12 months, yes, it is up closer to 30%. But PayPal right now at $73 billion in market cap. PE trailing 16.5, forward 14.3. With everything that this company has been showing us over the last couple of weeks and months, I mean, to me, this is another one of those no-brainers, right? While the market might be at all-time highs, where we might have plenty of companies that are extremely overvalued right now based on hopium and whatnot, a company like PayPal, maybe even Alibaba, not maybe even, Alibaba is another one I'll put in that category. It's just extremely undervalued. Yes, this might not be super high growth stocks, but these stocks are priced as if they're not growing, and yet they are. So yeah, I have to put PayPal there yet again. Now with PayPal, what are the catalysts? What would make this stock move? Because I know I get these questions quite a lot, so I'm basically changing the format of this video. So I think with Braintree, when we see growth reaccelerate, that will be one of the catalysts. Venmo continued monetization is another one. More comments on the advertising business. We know that ads are going to become an important part of the whole PayPal offering. So more commentary on that, because, well, if Uber can generate $1.5 billion from advertising annually and growing 60+%, then a company like PayPal should be able to turn this into $1 billion business as well. More comments on the omni-channel momentum that they're having across the board, right? Across everything that they're offering right here. We're of course going to get all of those information during the next earnings report and earnings call. And then the continued transaction margin dollar trend on the way up. Yes, take rate is still quite low and might even decrease a little bit more, although we might be surprised and suddenly take rate has plateaued, and that might actually be viewed as something good. But yeah, these, in my opinion, are going to be the catalyst that in the short term will definitely push the stock back to, well, closer to $90, which is where we were at the start of this year. Now, in the meantime, PayPal can just continue to gobble up shares, right? They can continue to buy $6-7 billion worth of shares each and every year. That's between 8 to 9% of the company. Each and every year, if the stock doesn't move, but the business continues to perform well, this is what you're getting here. And well, we are going to get rewarded, even if there is no multiple expansion. Just the fact that shares are getting, well, retired, that's going to have a positive effect on earnings per share, of course, and on, well, share appreciation over time. We've also heard some positive commentary on Venmo. So Venmo grew over 20% last quarter. Venmo revenue target of over $2 billion by 2027. New Venmo cohorts show 10% debit card attachment within the first 30 days. Perplexity will be using PayPal's MCP server to drive branded PayPal and Venmo checkout. We've also heard well, more comments on PayPal and Venmo when it comes to the college student and college sports. So it's all about making sure that people use the PayPal ecosystem more and more. More money comes into the ecosystem, gets monetized. And I mean, again, undervalued in my opinion. And Braintree's TPV growth was 2% in the first quarter, with expectations for acceleration in the second half of this year. Like I said, this is a company that is basically priced as if it's not going to grow, and yet it is expected to grow. Yes, in fiscal 25, growth is really low, 2.7, probably 3%, but I think the market is just getting it wrong. But then it's expected, according to the analyst, expected to grow 6 to 7% in the upcoming fiscal years. Margin-wise, especially gross profit margin, we are seeing it rebound a little bit. Free cash flow margin right now sits at 18.7%. In 2024, we had a one-time positive hit, so that's why it's that high, but I still expect it to stay quite close to the $20. Overall, I mean, yes, more and more people are actually using PayPal. Actually, more people are using PayPal today than ever before. So again, another proof that this is not a dying business whatsoever at the moment. If we look at transaction margin, that has been improving quarter after quarter. So that's another positive thing. Of course, here the year-over-year increases, as you can see, are because, well, the year-over-year comparisons are extremely easy. All in all, transaction margin dollar has been doing quite well. If we look at transaction margin, that actually improved 274 basis points year over year last quarter. And so with PayPal, yes, it's true. Over the past 12 months, stock is up close to 30%, but the market and probably other fintech players are up more, right? But yeah, that's only short-term thinking. I strongly believe that if PayPal continues to execute the way they've been doing since Alex Chriss came in, I strongly believe that PayPal can revisit all-time highs probably by the end of this decade. I mean, that's quite big market-beating returns. Of course, you have to be patient. If you are not, then forget about it. Moving on to company number 3, and that's Qualcomm. Qualcomm, as you can see, over the past 12 months is down 20.8%. Year to date, the company is now up barely 3.1%. Over the past 3 years, stock is up 28.2%, and over the past 5 years, the stock is up around 76.4%. This is a company with a market cap of around $175 billion. Trailing PE 16.2 times, forward one 13.7 times. You might automatically say, very cheap for a company like Qualcomm, right? Semiconductors, I mean, they usually trade at a higher PE than this. Yes, true. But historically, Qualcomm has never really traded at such a high multiple to begin with. Actually, revenue-wise, as you can see over the last 3 years, has only grown by 2.5%. If you look at forward 2 years, an acceleration, 6.5%. Margin-wise, still a very good business. Now, at the start of last month, we had a NASDAQ summer conference, and they said the following thing. They're targeting $8 billion in automotive revenue by fiscal 2029. That's quite a huge increase from where they are today, and I'll show you why. Aiming for 12% share of the PC total addressable market, equating to approximately $4 billion in revenue within 4 to 5 years. Targeting $4 billion in revenue from the industrial market in the next few years, and achieved approximately 9% share in the United States and Western Europe consumer PC market in the previous quarter. So, well, I'd say the goals here are quite aggressive. They also said the following: the company aims for a 50-50 revenue split between handset and non-handset by the end of the decade. Right now, as you can see, PE trailing 12 months, 16.2 times is very close to their own average. If we look at forward PE, it's a bit lower, but it has never really been that high, right? On average, we sit at 15.6 times. So yes, sometimes we were higher, sometimes we were lower, but on average, 15.6 times. Currently, we're not that far away from it. Operating margin, we've seen a solid, recovery from the lows here, 24.1% back in 2023. We're now making our way back up to the 28%. Revenue-wise, Yes, you can see that we have peaked back here in 2022. There was a huge cycle because of the pandemic, then went back down, and now we're making our way back up. Gross profit margin since then has come down a little bit, although we're still in the mid 50%. Free cash flow margin is still in the mid 20% as well, 27.7%. Now, Qualcomm, of course, it's the same like with an Apple, for example, right? Apple iPhone, if you have a huge refresh cycle, then they'll do well. Same here with Qualcomm. If we have a huge upgrade refresh cycle across the board for smartphones, for handheld devices across the board, that is going to be very good for a company like Qualcomm. And that's why they want to diversify the overall business. Because if we look at the split in their business, so you have QTL revenue and then this is QCT, all the rest above here, which means handset, automotive, and IoT. You can clearly see that handset is the majority, right, of the revenue here. But automotive is the blue bar, started very slow, and now we're closing in on $1 billion in revenue per quarter, and that's growing close to 60% last quarter. So very fast growing segment of their business. These were the results for Qualcomm last quarter. Very good results across the board, whether it's revenue or net income or earnings per share. In my eyes, very good results. Handsets were up 12%, automotive 59%, and IoT up 27%. So total QCT revenue was up 18%. If we look at guidance for Q3 fiscal 2025, they expect revenue between $9.9 to $10.7 billion, a split here between QCT and QTL, $8.7 to $9.3 billion QCT revenue, and QTL $1.15 to $1.35 billion, and GAAP diluted earnings per share of around $2.25 at the midpoint. Qualcomm is also a company that buys back shares and pays a dividend. The current dividend yield sits at 2.6%, and I assume the shareholder yield is a bit higher than that because you have to add the buyback yield as well. So with Qualcomm, it's true that it's been a bit disappointing, right, compared to the other semiconductor player, but I do think, again, value is found in this company, and I do think that it could beat the market in the upcoming years. Of course, execution here again is crucial. Last but not least, of course, can I make a video without including Google? No, I don't think I can. So last but not least, the no-brainer of no-brainers here is Alphabet Google. Yes, a company worth over $2 trillion can still be a no-brainer. Year to date, we are still down. Over the past 12 months, we are down as well. Over the last 3 years, we're up around 60%. And over the past 5 years, we're up 142%. This is a company that is, despite all the titles that you might have seen, is firing on all cylinders. This is a company trading at under 20 times earnings, and forward one is also here at 19 times. This is a company that, how many times can I talk about Google, right? Plenty of times. That's how many times. And so since I made so many videos about Google in the last couple of days, these are the catalysts for me, the short-term catalysts. So the upcoming earnings report, we will see cloud growth. I won't be surprised if that reaccelerated. We will see Gemini usage. So the data that we're going to get there, the commentary that we're going to get there, I think will be appreciated by the market. Search query growth, again, all about narrative, because that's the last point here, the narrative shift. Currently, the narrative is against Google. And once that narrative will shift, you will see the stock go above $200. No questions asked, because, it deserves to be above $200. Plain and simple, because it is such an amazing business, right? It's an amazing business where the stock price just isn't currently following what it used to follow, which is net income. Funny enough, net income, for those that missed the other videos, net income, it's higher than Apple and Microsoft, making it now the most profitable company out there. But I guess that's not important for the market at the moment. Search, the largest segment of the business, yes, it is slowing down a tiny bit, still growing close to 10% year over year. And that's a business generating over $50 billion each and every quarter. YouTube ads is still doing very well. Google Cloud is expected to become a huge part of the overall business. I've shown you what happens when Google Cloud continues to grow quite quickly. Same with net income, same with operating income, I should say, and margins start to expand as well for this specific segment. how big of an impact that will be for the overall revenue and overall operating income, it's very, very bullish, right? Even if search slows down quite dramatically, I think this is a business here that just gets overlooked for one reason or another. So yeah, I mean, Google Alphabet, it will still be in my videos each and every time as long as it is below $200. So here it is yet again. I do have to correct myself because apparently there was a report that came out yet again. So OpenAI this is still true. OpenAI taps Google in unprecedented cloud deal despite AI rivalry. This is true. With regards to the TPU part of it, they said they are trying it out. It's not going to be at scale. So that's the only difference, right? Because previously we heard that, they're going to use Google Cloud and Google's TPUs, the older versions, and that's about it. But now we have more information. So yes, it is true, but it's not going to be used at scale at the moment. Okay, no big deal. And so all in all, that's about it for me in this video. Do share your picks for the month of July down in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one. Bye-bye.